Problem 1633. We're going to do the whole statement of cash flows. So accountants for Smithson Incorporated have assembled the following data for the end of the year. So we've got our current assets and current liabilities, and then other miscellaneous data in here. So as usual, we're going to start off with operating section. And what goes in the operating section, we're going to start off with net income, depreciation, back out any gains or losses, and then analyze changes in current assets and current liabilities. So we need net income first. So net income is down here, $69,500. $69,500 of net income. And what's next on our list, on our cheat sheet, is depreciation. And remember, for depreciation, we're going to add it. And if you need to refresh your memory about why we add it, here's a link to the video name. Depreciation expense, and here's our depreciation expense. 25,000. We're going to add it per the rules. Now we're going to look through here for gains and losses. We've got a gain on a sale of a building, $4,000. Now remember, gains are going to be backed out. So how do you reverse a gain? A gain added to net income. So to back it out, you're going to subtract it. So that $4,000 gain will be subtracted. And then after that, we need to analyze our current assets and then our current liabilities. So here are our current assets and current liabilities. Cash goes at the very bottom of the statement of cash flows, so we ignore that for now. So we're going to analyze AR, current asset. Here's the prior year, here's the current year. And it looks like AR has decreased $6,000. So if AR decreased, what happened? Well, our customers must have paid us off. And if our customers pay us off, which way does cash go? Cash goes up. Hence this rule, decrease in current assets, you add that. So we're going to add that $6,000. Decrease in AR. Next, we've got an increase in inventory. So if inventory increased, we must have purchased inventory. And if we purchased inventory, cash is going which way? Down. Hence the rule, increase in current assets, you're going to subtract. Increase in inventory. It looks like the change is a $5,000, so it's going to be a minus 5,000 since cash must have gone down. Next in line looks to be an increase in AP, a current liability. So if a current liability increases, you're going to add the difference. Increase in AP. It looks like the difference is $1,900. And last but not least, we've got a decrease in income tax payable. Now this one is pretty intuitive. You can just logic your way through this one. If our income tax payable, a liability, goes down, then we must have paid it off. So cash also goes down. Hence the rule, decrease in the current liability, you have to subtract cash. Decrease in income tax payable. It looks like the difference is $2,600. We're subtracting because cash went down. And that's all the analysis for all the current assets and current liabilities. So we can now just sum this section here and put the subtotal right here. So we should get 21,300. Scroll down, and then to get net cash provided or used for operating activities, we're going to add these two since they're both positive numbers, and we get $90,800. So what that means is the company's current operating activities are providing a positive cash flow, $90,800. That's good. So we're done with this box, the current assets. We'll come to cash later. Let's open up our other data. So we're now in the investing section. So what goes in the investing section? Well, right here it says changes to long-term assets. And if you like this visual, you can look here, changes to long-term assets goes in the investing section, such as buying assets, long-term assets, and selling long-term assets. So let's look through here and see if we have any cash transactions that involve long-term assets. So I'm going to start over here on this side. Common stock is an equity, so we can skip that. Depreciation expense, we've already got in the operating section. Purchase of equipment with cash. So this is going to go in the investing section because equipment is a long-term asset. So purchase of equipment or acquisition of equipment. Cash. Payment for acquisition of equipment. And since we paid cash, that's going to be a minus $73,000. Well, let's keep going further. We've got acquisition of land, a long-term asset, but we do not pay cash. It's long-term note payable. So that's going to go in the fourth section, non-cash investing and financing. So we'll skip that for now. Book value of building sold. Oh, yes. So we sold the building. Now, this is the book value of the building. This does not say how much cash we got. So we have to calculate the cash we got. But let's look through here just to make sure there are no other long-term assets. So we got note payable, dividends, notes payable, gain on sale of building. So we've got these two pieces of information. But what we need to do is use these two pieces of information, the gain and the book value of the building that was sold, to calculate the cash. So let's review really quick on a PowerPoint slide. So in this example on this slide, we're calculating cash from sale of assets. In this case, it's the building. So the building, remember the plus side is over here on the left side. The book value of the building, book value means costs minus accumulated depreciation, was positive $40,000. So when we sell this building, we have to get rid of this debit balance. So we credit it. So that's why this on the transaction down here, the building, the book value, is being credited $40,000. Now, apparently, in this case, we received cash of $50,000. So that is increasing. And then the transaction does not balance, so the balancing amount is $10,000 on the right side. So if we have a building worth $40,000 and you get $50,000, we must have made a gain. So that's why this is a gain. You also know this is a gain because if it's on a credit, gains are like revenues, and revenues are credits. So how does this relate to the problem we're doing now? So in the problem we're doing now, we know we sold a building and we know we had a gain, but we don't know this amount. So this amount is the amount we're looking for. So let's go back to the My Accounting Lab and look to see what the data said. So the book value of the building that was sold was $53,000. So we can change it from our example of $40,000 to $53,000. Now we had a gain. What was the gain? Well, let's go look, because I certainly don't remember. The gain on the sale of the building was $4,000. Remember, gains are like revenues, and revenues are credits. So gains go on the credit side. Now, can we calculate how much cash we must have received? Well, we must have received $57,000. And then this amount, the $57,000, is what goes in the investing section. And since cash is going up, it's going to be positive. Cash receipt from sale of building, positive $57,000. And we've already looked through everything else. There are no other changes to long-term assets. So we're going to sum these two and we get minus $16,000. So that means we have cash used, not provided by, but used for investing activities, a $16,000 cash outflow. So that was probably the hardest part of this problem. Now we're going to do the financing section. So to review, what goes in the financing section? Changes to long-term liabilities, changes to equity. You can also look over here. This is the visual way of saying that. So we're going to look for changes to long-term liabilities that involve cash and changes to equity that involve cash. So let's just start here in the left column. We issued common stock. That's an equity account, so it's going to go in this section. And we received $42,000 of cash. So cash receipt from issuing common stock, positive $42,000. Let's go down through here. Depreciation expense goes in operating activities. We already did that. Purchase of equipment with cash, we've already done that. Acquisition of land by issuing a long-term note payable. Now this is financing here, but it's not cash, so that goes in a non-cash investing and financing. We've already done the building. Payment of note payable. So the note payable is a long-term liability, and since we paid it off, this is going to be a minus $42,000 because cash went down. Minus $42,100. Cash payment of notes payable. The next one, we've got payment of cash dividends. So cash dividends will eventually lower retained earnings, which is an equity account. So therefore that does go in the financing section. And since we paid cash, it's going to be a minus $52,000. Cash payment of dividends. And then we issued a note payable to borrow cash. So note payable is a long-term note, is a long-term liability, so it goes in the financing section. And since we issued it, we received cash, so it's going to go as a positive $60,000. Cash receipt from issuing a note payable. And we've already analyzed the gain, and we've already done the net income. And we don't have any more room. So that must be it, since we've analyzed all this data. So now what we're going to do is we're going to sum these numbers, and we get positive $7,900. So we've gotten some cash flow, not a lot, from financing activities. Most excellent. Okay, we're done with this window. We can open up the other window because we need our cash balances. So we need our change in cash. So if we look here, here is our prior number, prior amount of cash, and here is our current cash. So it looks like cash went up, and the amount that went up was $82,700. But we should double check this math to make sure these sections are correct. And by these sections, I mean the 90,800 minus 16,700. They need to sum up to these. So let's see if they do. 90,800 plus 16,000 minus 7,900 plus gives us positive 82,700. So we've double checked that our sections are correct. And then here is our beginning cash, which is 20,000. And then we get our ending cash right here, 102,700. So we're done with this. And then we need to look for that non-cash investing and financing. And that was right here. We acquired land, but we did not pay cash, so it does not go in the investing section or the financing section. And it's 118,000. So it goes in here as a positive. We have positive acquisition of land, and we have more debt. Acquisition of land by issuing long-term note payable. And that's all, according to the box, that's all the only non-cash investing and financing we have. So we just put the total here. And that's it.